Hey friends, today we're diving into a gold rush happening right on Orchard Road. Singapore's luxury retail scene is heating up with billion-dollar deals that most investors are completely missing. Most people think retail is dying in the age of e-commerce, especially after the pandemic hit brick-and-mortar stores so hard. But I've uncovered evidence that Singapore's prime shopping district is not just recovering, it's becoming a hotbed for smart money and institutional investors willing to pay record prices. I've analyzed the numbers behind recent landmark deals and found that the market is seriously undervaluing some of Singapore's trophy malls. In the next few minutes, I'll show you exactly where this disconnect is happening and how you might capitalize on it. I'll break down the Ion Orchard mega deal, explain why Orchard Road rents still have room to grow, and reveal which REITs are trading at puzzling discounts to their true value. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Let's start with something that shocked even seasoned real estate investors. The Ion Orchard deal that just happened is absolutely mind-blowing when you look at the numbers. A 50% stake in this mall just sold for $185 billion Singapore dollars. Do you know what that works out to per square foot? Nearly $6,000 per square foot. Think about that for a second. That's like paying for a luxury condo, but for every single square foot of retail space. And the yield, just 4.9%. Investors are accepting lower returns because they believe so strongly in the long-term value of this premium asset. But here's where it gets even more interesting. Hot on the heels of the Ion deal, we saw a privatization offer for Paragon REIT that values Paragon Mall at around $4,500 per square foot with a 5.2% yield. These aren't just random transactions. They're part of a pattern showing that smart money is betting big on Singapore's luxury retail. Have you ever wondered why these investors are willing to pay such premium prices? What do they see that others might be missing? The answer lies in scarcity and consolidation. These deals are further consolidating ownership of Orchard Road malls, making them even more exclusive and harder to acquire. It's like a game of Monopoly where the prime properties are quickly being snatched up by players with deep pockets. Now, here's the most exciting part that most retail investors are completely missing. Despite these record-breaking deals, Orchard Road's passing rents are still about 4% below pre-pandemic levels. This means there's still room to grow. Think of it like buying a stock that's still trading below its previous high, even though all the fundamentals suggest it should be worth more. That gap is likely to close fast, and here's why. First, we're seeing price harmonization by international luxury retailers. What does this mean in simple terms? Luxury brands are working to make their prices more consistent across different countries. For Singapore, this could mean better pricing compared to other luxury shopping destinations. Second, the Singapore dollar has been weakening slightly. While that might not sound great for our savings, it's actually fantastic news for tourism and retail. A weaker SGD makes shopping in Singapore more attractive to tourists from around the region. And speaking of tourists, regional consumer confidence is bouncing back. As Asian economies recover from pandemic disruptions, wealthy shoppers from China, Indonesia, Malaysia, and other neighboring countries are returning to Singapore with their wallets open. Are you starting to see the opportunity here? The big institutional investors certainly do. Now let's talk about how you might be able to get exposure to this trend without needing billions in your bank account. This is where REITs, real estate investment trusts, come into play. Our analysis shows that the market is seriously undervaluing prime central retail assets owned by Singapore REITs. Current share prices imply yields of 5% to 10%, which doesn't align with what we're seeing in actual transactions like the Ion and Paragon deals. In other words, you can potentially buy shares in these REITs at prices that value their malls at less than $3,000 per square foot, almost half of what Ion just sold for. It's like buying gold at silver prices. If you've been following my channel, you know I'm always looking for these kinds of disconnects in the market. They don't last forever, but they can create interesting opportunities while they exist. Among retail REITs with central exposure, Capital Land Integrated Commercial Trust, CICT, stands out for its superior central retail yields. The market consensus seems misaligned with its profile, which includes trophy orchard assets. If you're looking for exposure to Singapore's prime retail scene, this could be worth a closer look. But wait, there's an even more intriguing possibility with Lend-Lease Global Commercial REIT, LREIT. Currently trading at just 0.66 times its book value, LREIT could potentially emerge as a privatization candidate. Think about it. If its sponsor or a third party sees the same value disconnect we're discussing, they might decide it's cheaper to buy the whole REIT than to acquire similar assets on the open market. Have you ever bought something on sale that you knew was worth much more? That's essentially what's happening here with these REITs trading below their book values. Before you rush to buy these REITs, though, let's consider some potential challenges. Retail is still facing headwinds from e-commerce competition, and consumer sentiment hasn't fully recovered from recent economic uncertainties. There's also the question of how long luxury spending can maintain its momentum if we face a global economic slowdown. But here's my take. Singapore's position as a luxury shopping destination in Asia is only getting stronger. The government continues to invest in making Orchard Road a world-class shopping street, and the limited supply of prime retail space creates a natural floor for valuations. If you're building a diversified portfolio, having some exposure to these high-quality retail assets could provide both income through dividends and potential capital appreciation, as the market eventually recognizes their true value. So what have we learned today? Singapore's prime retail scene is experiencing a gold rush with record-breaking deals for trophy malls like Ion Orchard and Paragon. Despite these transactions at premium prices, there's still room for Orchard Road rents to grow as they remain below pre-pandemic levels. Most importantly, we've identified a potential market mispricing where REITs with exposure to these prime retail assets are trading at significant discounts to their underlying property values. CICT offers superior yields on its central retail assets, while LREIT's deep discount to book value makes it a potential privatization target. Whether you're looking to add some Singapore retail exposure to your portfolio or just trying to understand where smart money is flowing in the region, I hope this analysis has given you some valuable insights. What do you think about Singapore's retail scene? Are you bullish on luxury malls, or do you see challenges ahead? Drop your thoughts in the comments below. I'd love to hear your perspective. And if you found this analysis helpful, check out my recent video, REITs Benefit as Recession Fears Rise, where I explore how Singapore REITs could see a 15% upside by the end of 2025. With recession risks rising to 40% and interest rates dropping, defensive investments like REITs might be poised for a surprising comeback. I break down JP Morgan's insights on why REITs offering yields of 6.3% could be a game changer for income-focused investors in these uncertain times. Until next time, this is Iggy from the Investing Iguana, helping you navigate the jungle of investments. Take care, friends.